Dr. Meredith Arnold McIntyre, a Grenadian national, received a Bachelor of Economics honors degree from the University of the West Indies, Cave Hill campus, Barbados in 1982. In 1985, he was awarded a Fulbright scholarship and completed a Master in Economics at Yale University. Subsequently, he received a Commonwealth Scholarship to attend the University of Toronto and was awarded a PhD in Economics in 1990. Dr. McIntyre had an extensive career in the region, working for the Caribbean Development Bank, the OECS Secretariat, a consultant with the Caribbean Export Development Agency, and the CRNM. It is an honor to welcome the keynote speaker of this symposium, Dr. Meredith Arnold McIntyre, to deliver his address titled Reinvigorating Growth.
Good morning. Your Excellency, the Governor, Dr. Eugene Holliday, and Mrs. Holliday, Prime Minister Marlin, Council of Ministers, Honorable MPs, fellow speakers, distinguished guests, ladies and gentlemen. Please allow me to thank the Governor and his team on behalf of the International Monetary Fund for asking us to participate in your National Symposium. It's a real pleasure. I was here maybe 3 weeks ago with the IMF doing our annual surveillance of the currency union of Sint Maarten and Curaçao, and it is a great pleasure to return again with my wife. I chose to speak on this issue of unlocking sustainable growth in Sint Maarten, partly because previous speakers had spoken to the other dimension and critical dimensions of development, ecosystems, education, and so on. And with the limitations of a simple economist, I have to speak to what I feel I can add some value. What I will say to start is that this question of growth has preoccupied economists and people of various disciplines for many, many years. In the Caribbean region, perhaps our most famous piece of writing on this is by Sir Arthur Lewis when he wrote his book, Modern Economic Growth. We have learned a few things over the last 30, 40 years about society's efforts to achieve stronger growth. And one of the things that we have learned is that it requires a partnership between the various actors in our countries. In my first slide, I tried to point out what are some of the interacting factors in economic growth: social, environmental, and economic. And in your National Symposium, you have touched on all. As our colleague on the environment pointed out, a sustainable environment is vital to achieving economic advancement. But you can only do that if growth is inclusive and equitable. And the environment has to be able to sustain the growth path that you are on. But you also require economic policies to give birth to ideas, targets, and actual economic growth. So inclusive growth requires stronger resilience, something that was mentioned before. You must create jobs, you must reduce poverty, and you must improve living standards. All of which Sint Maarten has done over the last 30 years or so. I focus on two aspects of this partnership: the government and the private sector. Not because they're more important than the rest, but it's more relevant to what I have to say. The government has to ensure or focus on macroeconomic stability. It has the responsibility of being fiscally responsible. It has the responsibility of ensuring that the society saves adequately, particularly in Sint Maarten, for natural disasters given your proximity to the hurricane belt. It has the responsibility to ensure that business activity can proceed as efficiently as possible. And as my colleague, Dr. Peterson said, encourage entrepreneurship and innovation. Therefore, you need a simple and efficient tax system, and you need minimal red tape. But most importantly, it has the responsibility of human capital, investing in your people to ensure that you remain high-quality, productive society. So education and training and workforce flexibility, both of which I will say some more later on. The private sector has its own set of responsibilities. It has to develop viable business cases, strive for international competitiveness, in other words, seek to penetrate international markets, pursue greater economic diversification in goods and services, play a leading role in defining the qualification and educational society, educational standards and occupational standards the society needs to keep sustaining growth. Collaborate with the unions to establish appropriate labor standards and regulations that don't impede business activity and secure worker and labor security. There are other actors in the country, of course, but we can discuss that more in the conversation that we may have. The international community also comes as part of your partnership. It provides policy advice through institutions like the IMF and so on. It provides training to help you build up your human resource skills in various areas. It can provide technical assistance, and it can provide financing, both concessional and non-concessional, to assist you in meeting your development efforts. In a thumbnail sketch, that is the broad partnership upon which societies, small islands, large countries rely upon to pursue this goal of economic growth and advancement. Against this background, let us look at what St. Martin's recent macroeconomic experiences, what reforms we might need to we have identified to promote stronger growth while preserving fiscal and debt sustainability and financial stability. Let's look at your environment and see how you're doing vis-a-vis the region that you are surrounded by. If we look at this chart, starting in 2008 to 2015, it's demarcated at 2008 that is because precisely the beginning of the financial crisis and global economic slowdown. If you look at that chart, you see that you fared in the crisis far better than the rest of the Caribbean. If you look at the ECCU countries, or otherwise known as the OECS countries, who have a currency union just like you, their growth plummeted to almost minus 5.5% in 2009, and the Caribbean more generally, which would take in Jamaica, Trinidad and Tobago, Guyana, CARICOM, their growth plummeted to about 3.5%. But you look at Curacao, just below zero, marginally negative, and St. Martin, virtually zero growth. But if you keep your eyes on the red line for Curacao and the green line for St. Martin, you will see that St. Martin dipped in 2011, recovered somewhat, got back up to about 2% growth, and remained fairly stable. The Caribbean and the ECCU countries rebounded strongly after 2011-12. And you would see the ECCU countries went up to almost 4% and the Caribbean 2%. Curacao had some negative growth in 13-14, largely because of the fallout of Venezuela. But you would see that all three countries, the Caribbean, the ECCU, and St. Martin, heading in the wrong direction as we go towards 2016. What does the chart tell us about St. Martin? What it says is that you demonstrated some resilience to the global economic slowdown, but you are stuck somewhere between 0 and 1.5% of growth, and you cannot break out of it. Some economists call this a middle-income trap, that as countries move from poor to lower middle income to middle income, and your per capita income is around 24,000 US, you're far more wealthy than most parts of the Caribbean, you're finding it difficult to get ahead from there. And that, I would suggest to you, is the central challenge you face. How do you move from a very sluggish rate of economic growth to a stronger rate of economic growth, to provide those things we mentioned at first, to reduce poverty, to build economic resilience, and to provide jobs and a higher standard of living? We look at the region, what investment are you receiving from the outside world? And you would see in the Caribbean that the FDI, foreign direct investment from the other islands, with the exception of Belize, is considerably higher than you're receiving in St. Martin. And you and Curacao get about the same, about 2.6% of GDP, notwithstanding the fact that both you and Curacao have significantly higher levels of per capita income, except for the Bahamas. So you're not really attracting a lot of foreign investment coming out of the crisis. Nowhere in the Caribbean really is, but you are at the lower end of the spectrum. And we have to ask the question, why such a wealthy, prosperous country cannot do better? What's your situation with unemployment? Well, Trinidad and Tobago stands out as having the lowest unemployment in the region. And then on the upper end, the Bahamas suffered the most coming out of the crisis, 2010, with its unemployment rate. But you will see if you look at Curacao with the dotted line and you look at St. Martin with the dotted green line, Curacao a lot higher than you, your unemployment rates are relatively lower than the rest of the region, but still unacceptably high for your society. What we do when we dig a little closer into this question, what about your labor productivity? And I looked at you and Curacao and yourself, because you are a currency union. You are two countries who share a common exchange rate as your anchor of economic policy. We certainly in the IMF think this is a good arrangement for you and it has served you well. And if you look at the towers, you would see the green towers are for St. Martin. Your productivity from about 2010-11 has surpassed Curaçao's productivity, but look at the trend, it's going down, as is Curaçao's, going down. Your productivity levels are not sufficiently high to drive your economic growth forward. The question is, what's the situation with the quality of your labor? Do you have the skills you need? Are you producing the expertise you need to service the main industry upon which you rely? Notwithstanding the slow growth, tourists are still coming here. Your tourist arrivals continue to increase. In 2014, you had a particularly good year, not as good in 2015, but you're still getting increases in tourist arrivals and stayovers. You're not seeing a reversal of your main industry and business. Your public debt, importantly, is well below neighboring countries. If you look at the Caribbean and the ECCU, in 2015, the Caribbean is averaging just about 65% of GDP in debt, and that is largely due to the Trinidad and Tobago, whose debt is about 40% of GDP. And the ECCU is just above that, and Curaçao is just over 40, and St. Martin is less than 40. So your debt situation is very good, exemplary, and suggests that you don't face significant financial vulnerabilities from over-indebtedness. But your debt has increased since 10-10-10, but I wouldn't make too much of that. And the arrangements you have with the Kingdom of the Netherlands over your fiscal rules, you have done very well in meeting those targets and those arrangements. So you would have what economists would call fiscal sustainability. Your government finances are in pretty good shape, and your debt levels are low. Similar to the other ECCU countries, your current account and your balance of payments, in other words, are you generating enough foreign exchange inflows from your exports and your from your exports of tourism and your foreign investment inflows to pay for the goods and services you're buying from the world? And largely that is the case with you. You're doing quite well there. As a currency union, you're doing quite well there. And of course, all of us have benefited from these very low international oil prices, which have substantially cut your oil import bill. So on the external side, you're not seeing that you're losing foreign exchange reserves, that your current account is getting worse, et cetera, et cetera. So external sustainability also looks in reasonably good shape. The financial sector is stable, but risks are increasing. If you look at what we call the capital adequacy ratio, how stable and do your banks have adequate capital as set out by the limits, by your regulations through the central bank, you'll see that basically over the years, the capital adequacy ratio of your banks well exceeds what the regulatory requirements are. So your banks are well supported. However, if you look at your non-performing loans, you will see that since 2008, there's been a steep increase in your non-performing loans. There are sectors in the economy which are not doing particularly well, and these businesses are facing significant challenges. And if you look at, given this situation, are your banks profitable? If you look at return on assets, you would see that the profitability of your banks since 2011 or so has taken a significant hit. And then when you say there's a lot of money in the banking system, liquidity, there's a lot of money sitting down in the banking system, but the credit to the private sector, is the private sector borrowing and investing? The answer is not really. This is true throughout the Caribbean, especially in the ECCU currency union. A lot of banks fund themselves largely through mobilization of deposits. A lot of deposits, a lot of domestic currency liquidity sitting in banks, very weak private sector credit expansion, and resultantly very low profitability or return on assets for banks. What does your outlook look like from the point of view of the IMF? When we look at you, we think that both yourself and Curaçao, and you somewhat better than Curaçao, we see that over the next few years, you could achieve growth of about 1%, considerably lower than where we think the ECCU and the Caribbean might be. And Curaçao, because of the uncertainties about the future of Venezuela and the linkages they share with Venezuela, we are slightly less optimistic, and therefore about 0.5%. So as a currency union, you have modest economic growth prospects. And what we feel is that your main challenge is that you are not getting enough investment. You have weak investment, as we discussed before, and that's the challenge that as a country you face. And then there are concerns about the functioning of your labor market. let's talk a little bit more. Are there any risks to this outlook? Could the outlook be worse or better? It could be worse. Things can always be worse. They could be worse if FDI is lower, if you experience natural disasters, and if the Zika virus somehow happens to affect your tourism industry. We think these risks for you, however, are moderate. We don't think that they are immediate. Upside, there could be stronger growth in the United States, which is going to, of course, facilitate your tourism industry and other forms of business activity. We have just revised somewhat downwards our growth prospects for the United States, but they're still, overall, the US economy looks in much better shape than it did 2 years ago, especially the jobs market and the level of unemployment. But in the United States, we're only now beginning to see some growth in wages. They had a very stagnant recovery in terms of wage growth and people's personal consumption and so on, but that seems to be improving. Let's look at this question of reinvigorating growth, getting stronger growth, and this issue of weak investment. Some explanations that we've come across look lack of confidence after a prolonged recession. The world has gone through a very prolonged recession, and the recovery out of the recession has been relatively weak to moderate. Even as we talk about the United States recovering, it's not recovering at 3 and 3.5% of GDP growth, it's recovering more at 2 and less than 2.5%. Europe is stuck somewhere between around 1% and the United Kingdom at about 1.5% of GDP growth. So the growth coming out of the advanced economies has not been particularly robust. And therefore, your economic linkages are essentially with the United States and parts of Europe. And therefore, because of that, people wonder, given the sluggish economic performance in your trading partners, does long-term investment in countries like yours with strong linkages carry substantial gains down the road? The most dynamic part of the world has been Asia, but then the region has very limited linkages with Asia. But we also feel that there are domestic factors at work here. How easy and efficient is it to set up a business in St. Martin? Obtaining a license and the variety of economic permits that a business needs to get going. Best practice in the world is Singapore. You can do it in 24 hours and you can do it on a computer. You haven't got to go to a single office. Asia does this. Asia is digitalizing all of its systems and going through this online. Mexico now, you pay all of your taxes online as well. So digitalization of government processes and so on is producing higher levels of efficiency. And that's what you need to compete with. So businesses coming here or showing some interest here may find it difficult. They're not sure what is the roadmap. What do I need to do from step 1 to step 10 to set up my business? And how quickly will I do it? And how does that compare to some other part of the world or some other part of the region? Your labor market. One of the interesting features of globalization, people talk a lot about the fact that globalization produce unprecedented flows of capital around the world, and some of that has been disruptive. That may or may not be true. But one of the things about globalization, it is probably one of the less known features of globalization, is that it's produced a substantial mobility of labor all around the world, and in particular, skilled labor. People who have skills and certificates now don't see a national or regional job market, they see a global job market. And as language ability, as people become multilingual and speak 1 or 2 or 3 languages, this takes even greater precedence. And small islands in the Caribbean with populations of 80,000, 100,000, 150,000, 250,000, as you seek to come out of that middle-income trap, as you seek to expand the range of business activity on that island, where land is not an abundance resource, it's a scarce resource. There are physical limits to how much economic activity you can place on an island. You need to have a relationship with the world's labor market. That is an inescapable fact. The question for you is on what terms will you have that relationship? And we think that this constraint on the hiring of foreign workers is a matter that as a society, we don't have recommendations, but as a matter of society, you need to sit down and think about exactly very carefully about that, how you will engage, but engage. Given the productivity levels that we have seen, maybe wages and wages could be an issue. Are your wages consistent with your productivity? But then again, we have to look and see how much investment are you putting into your workers to ensure that their productivity is growing over time. So it's not as straightforward as just saying wages are higher than productivity, therefore wages must come down. That's the wrong conclusion. Don't draw that one. Don't draw that one. It's not as straightforward. And then when we say, based on the economists use a lot of concepts, and sometimes what I try to do is to make some of them user-friendly. One of the things that they say is exactly, give me your endowments of labor, skills, capital, etc. What is your sort of maximum level of output? And right now, if you look at that sort of dark line, that's that dotted line, the blue line, that is your potential GDP, where given your endowments of labor, capital, and so on, broadly speaking, that's where your potential GDP can be. You would see that your real GDP, sort of 2008, exceeded that, but now you're pretty much close to potential. And that's why we think maybe there's a middle income trap. Given that you have what you have available to you, you cannot really produce more. You need investment, physical and in human capital. So, what does this say? Need labor market reforms to improve flexibility and address skills matches, ease restrictions on foreign workers and make those processes efficient. But most importantly, the people of St. Martin need to be brought into the labor force in a far more productive way. And that's why we think when you look at societies, you ask, does a country have a large infrastructure gap? Does it have its roads, bridges, ports, etc., in good or poor condition? Is that servicing business activity or not? And when we look at St. Martin, you have a very high quality of infrastructure in our judgment. You always have things to do, but you have a very high quality of infrastructure. Good roads, well-connected country, etc. So there's not so much an infrastructure gap. But then they ask the question, what about your skills, your level of education and expertise? There is where we think you need to focus public spending. And not necessarily in tertiary education, in intermediate levels of education, vocational education, and targeted programs. Increase the IT penetration in the society to move towards a more efficient public service. You know, as they say, a modern society requires a modern government. And to move to a more efficient society, you need to digitalize and computerize a lot of the functions of government to improve efficiency. And to do that, the IT skills and IT penetration in the country has to improve. And skills training programs in these areas are going to be vital. And the tourism industry, that is your key industry, also relies a lot on IT. Then the question of the business environment reforms to reduce the cost of doing business. The centralization of these processes, institutional arrangements that centralize these processes and try to do them as efficiently as possible. Again, digitalization would be important here. But then ask yourself, the series of regulations that I have, are they the right ones? Do I need them? Do I need these at all, or do I need maybe a lot less of these and maybe other areas? Like our colleague was pointing out, I would say, offer a judgment and say the environment is probably where you need to focus in terms of any regulatory reform. And then a last issue that's true for the region and very true for you, energy. All of our countries are very high-cost energy societies because we rely very heavily on imported petroleum, and petroleum prices are, if anything, but high and volatile. We are going through a current period of low international oil prices. The certainty is that it won't stay here. The question is what price will it rebound to? And therefore, moving ahead with an energy program, as you're doing, to expand the use of renewable energy, regulatory reforms, setting up an independent regulatory body to regulate your energy sector, we think is critical. And therefore, the pursuit of renewable energy initiatives to transform the generation mix and reduce the dependence on imported petroleum and lower cost renewable energy, we think is a medium to long-term reform that will suit your economy well. When we come to your fiscal situation, your government finances, you have had two fiscal rules that you have been using to achieve the fiscal sustainability. We would suggest to you that one of the things you may consider is to have a sort of medium-term framework where the government says that this country will not have a debt level that exceeds 40% of GDP over the long term. That could be over 5 to 7 years. And then you say, but that doesn't mean that you have to hit 40% of GDP every single year. It allows you to have some flexibility where you have critical spending to do, to invest, that is tied to your growth strategy, but at the same time, you commit to achieving that over the long term. But to do that, you have to have a certain target for the government's finances every year, which we call a primary balance target. And that primary balance target is well understood by your society. And the government is then accountable to societies for that. That is what your countries are judged by. This is very important in the context of a fixed exchange rate and a currency union. Europe has this very firmly embedded. Other countries who are not in currency unions, who don't have fixed exchange rates, decide to have an inflation target, and they would say that inflation in this country will not veer off between 3 to 5%. In the 1990s, as Brazil came out of hyperinflation and all kinds of nasty things, it set up an inflation targeting regime. It did not achieve the target within the first 12 to 18 months or even 2 years, I don't recall precisely. But what was important for business and for the country is that they explained very carefully to the world why they didn't meet the target and what they were going to do to achieve the target. This kind of economic management builds one important feature in your process: credibility. People believe that what you set for yourself you mean and you will try to do. And we think that given your level of development, perhaps a more appropriate arrangement for you, maintaining your fiscal rules, but setting up a medium-term framework anchored by a long-term debt to GDP. We say 40%. It's only out there, it's your choice. We say 40% because emerging market developing countries have a medium level of debt of 40%. Because at the end of the day, you would want to have your own sovereign rating in international financial markets and people to look at you and judge you and say, can I put my money here? How risky it is? What rating do you have? And therefore, this kind of macroeconomic framework will help you. But it's only a suggestion for you to consider. Let me close with a few observations. St. Martin has nothing to fear from an uncertain world, and an increasingly uncertain world. You may be small, you may be not a lot of people, but you have admirable achievements. That should give you a lot of self-confidence about your own capacity and ability to deal with challenges. The world has always faced challenges. I suppose once one is alive, you always face challenges. I would suggest proceed with self-confidence. Have a national vision about where you would like to go. All these decisions are yours within your capacity to make and decide for yourselves. Invest in your people. That's the most principal investment that you can make. And as the persons before said, the quality of your young people is there for us all to see. But don't lose sight of cooperation. Don't lose sight of cooperation. You are in a currency union, cooperate. You are operating in a region of other small islands. Seek to build partnerships with people. You know, Cuba is now liberalizing, and we see some Caribbean countries moving very assiduously on this. Jamaica and the Bahamas are establishing tourism marketing arrangements with Cuba that will allow multi-destination tourism, which means you can come into one country, you can book a holiday with 3 destinations and not one. That's cooperation. Where you have common interests, seek those common interests and build cooperation. An entire generation of Caribbean economists, Sir Arthur Lewis, William Demas, which my colleague quoted me, Sir Alistair McIntyre and others, built a body of knowledge on the importance of cooperation of small islands. Separateness does not take you very far. So I would urge you to keep as you're going, build on your currency union, build on your strengths, and approach the world with confidence. You have a prosperous future, just secure it. Thank you very much.